welcome to this week's update and insight into what's been happening around the markets. Look, this week, obviously, it's the end of the month, end of the quarter. We're just going to stop. We're going to pause and have a look sort of what's happened. March especially has been a bit of a roller coaster. It's ebbed and flowed in some huge ranges, and there's been some dramatic moves across most markets, and perceptions and outlooks and expectations have really swung around in dramatic fashion. So look, last time we touched base, we're in the midst of the banking crisis in the middle of March in the US. We had the collapse of Credit Suisse, a massive lender from Switzerland. We had the SVB collapse, and we had Signature Bank, and we had First Republic in a lot of trouble too. So off the back of that, we saw sweeping reform by the US Fed, announcing drastic measures to shore up liquidity and guarantee deposits for Americans and citizens alike. And off the back of that, we saw futures pricing for cash rates be down priced dramatically, and yields in bond yields and short-term cash repos and the like, they all dropped around 100 basis points. So from what we're looking at, a terminal rate of around 5.5%, we're now back in the mid fours, and the Fed may be nearing the end of their hiking cycle. They did move to a terminal, a Fed rate of 4.85%, so a 5% rate on the upper bound. They do have another meeting left, so it's interesting to see what's going to happen there. But yeah, from the banking instability and banking turmoil, that's spurred on investors and traders to perceive that this will trigger the end of the hiking cycle around the world from most central banks. The RBA in Australia has theirs next Tuesday, so they're priced into likely pause. There may be a chance that they go 25 basis points, but yeah, I think a pause, the consensus around the market at the moment. Now, an interesting thing we saw yesterday, the start of the week, so over the weekend, we saw Deutsche Bank run into a lot of trouble. You can see there, that was Monday. Their share price dropped I think it was around 7% from the high there, so 14%, and I think it closed up a little bit higher. But yeah, look, it came down to a low of about 15%. Now, that was spurred on by investors more or less speculating that Deutsche were going to be the next bank to run into trouble, particularly a big move on Friday in their credit default swaps, which is a insurance on corporate bond issuances. So you can buy insurance against those bonds to protect your cash flows and payoffs in the event of a default by the lender. By the borrower, beg your pardon. So the borrower is Deutsche. So they can protect your cash flows. So those have a premium to insure, and there was a run on them in the Friday session around Europe, and it caused these credit default swaps to spike in value. Now, obviously, that was noticed by investors and perceived as a red flag, and as a result, the Deutsche share price sold off quite heavily, and speculation and questions were raised. Now, the only real reason we have to speculate on why this occurred, it was just a punt by investors, thinking that with all the turmoil and all the heightened risk around banks, they thought Deutsche would have been the next. We do know that they're quite a risky bank. They have a lot of risk appetite, and their balance sheets may not be the healthiest. And yeah, so investors thought that, look, who's going to fall next? And they thought it's Deutsche. Now, however, this hasn't been the case. They've been able to stabilise through the week, and it looks like it was just a stab in the dark more than anything, and they're going to get out the other end. So yeah, that was that, and the week moved on as normal. So in really quite a nothing sort of week. US dollar, we can see here, it rallied a little bit through the March, the end through that February, but yes, since then has come off. Did start to weaken, obviously, over the period of the banking crisis in the US, lost considerable ground. But as we saw in that graph before, it's approaching that support level of the yearly lows. It's going to be interesting to see if we can get bust down through that 100 level. Aussie dollar, on the other hand, its March just been very range bound. This may be a bottom down in the 65s here. it's tended to trend upwards for the later part of March. Through the last sort of few weeks over the oil in America and Europe, it's failed to make any real direction up or down, and it's hovering around the 67 figure mark at the moment. Same goes for the US yields. Obviously, they were up considerably higher until the banking collapse. They're now sitting down at 3.9%. On the week, they have repriced a little bit of stability around the world, did ease. Yields popped back up a bit, and the view then turned to how the economy in the US is actually tracking, and whether these banking sagas was just a storm in the teacup. So they've looked to stabilise, and they're sitting around the 3.94% mark that's the 3-year yield. Been a decent month for shares. They've recovered well in March. S&P's tracked up nicely. As you can see here, it's bounced off the bottom of the 3,800, high 3,800s, and it's tracked up quite well to just above the 4,000 level mark, which is a key psychological barrier. It's interesting to see that wasn't really phased too much about the crisis in the banks and things. It somewhat just shrugged that off and kept on moving, which does beg the question that if stocks are unfazed by this, then how is inflation and growth for what's going to be the incentive to cut rates if investors and equities don't view it as that way? The Nikkei, much of the same picture, following global equities higher. I think the global equity index was around 5 to 7% higher around the world, which is a really pretty healthy rebound from what we have seen. Hang Seng, much of the same there. If we look at March, we're just about flat from where we started, but from mid-March, up 8% higher. So a decent recovery. Now, oil's an interesting one. It has come off quite a bit. Middle of the month, we were down at a low of $65 a barrel, which is just down below levels we saw before the Ukraine war outbreak. Now, that's touted. A lot of insiders have been touting that as seasonal demand has slumped, and there's quite a heavy supply and stockpiles around the world. And there's been other speculations that there's been quite a lot of volume of options, and there's been quite heavy option flow throughout the market, and hence the puts that the downside protection in delta hedged with short positions, which has moved helped to move the market lower. But as you can see here, usually those contracts expire towards the end of the month. As they have rolled off, we've seen the price come back up. Now that's up over $10 a barrel now. So look, the oil is hard to pick at the moment, but it's followed the sort of bounce back for the back end of March. Gold, now as you would expect, a tremendous month for gold. The haven demand for it spiked dramatically over the period, the bank collapses and things like that. Now it's up 8.5% from down in its range-bound trend in February, and just in the month alone, it's up around that level as well. So really good month for gold. We saw positions in the yen and the Swiss franc, which are also haven demand currencies, or haven currencies. We did see them spike initially, but since then, those positions have all been unwound, and the value of them has depreciated back down to the level below the level that they appreciated against. So gold's the really one that's actually held its value and then stood up. And it really speaks very highly of the attractiveness and long-term cyclical demand for the commodity. This is copper, so we'll just tighten this up a little bit, but it's holding on strongly above the $4 a pound mark in US. It's bounced back in March, but look, not a lot of direction. It's been quite range bound around the $4 level. So I think we'll need to see quite a heavy uptick in outlook on the growth of the economy and the risk appetite and sentiment. So that's about it on the markets. One of the main drivers of such a quiet week was there was hardly any data out around the world. Australia had virtually nothing. We did have an inflation print that came out a little bit lower, but it was only a monthly read. Retail sales, and out of the States, it was hardly anything. So tonight we've got the PCE data, which is closely watched by the Fed, as we know, because it is it's a very close indicator of inflation, and it's what they look at the most. So that comes out tonight. That also has got personal spending, but this number here is going to be a close one. The month-on-month number, the consensus is going to be 0.4%, and we'll see what that comes out as. I think that's so consensus is 0.4%. So we'll wait and see there. But yeah, apart from that, pretty quiet. We'll look on to next week. We've got ISM, got JOLTS, which is an important one. That's later in the week. Other than that, not a lot. Oh yeah, a bit of a breather this week. Markets are sort of taken a breath, reset, and worked out where to next. The consensus on the street is that rates are going to peak. It's going to be move to the next phase on how the economy is now going to handle a prolonged period of time with extended rates and higher costs of borrowing. Okay, thanks for tuning in. Thank you all for listening. I hope it's been insightful, and we will touch base again at a later date. Thank you all.